This morning at 6:34 as we kind of get this morning underway. A couple of interesting things. So the banks have been reporting earnings. J.P. Morgan yesterday beat earnings estimates as well as Bank of America. And, you know, this is the one thing that as investors you have to understand is like we've been saying for a while that you should avoid bank stocks in your portfolio. There's a lot of problems fundamentally with bank stocks. J.P. Morgan, Bank of America, all these guys. First of all, they've been underperforming by a large margin, which makes them less attractive. But fundamentally, they have problems as well, which is, you know, look, low interest rates are not good for banks. Banks make money by loaning money. They also make money by trading stocks. And so that's been the one thing where they've been beating earnings is by creating revenue through trading equities, right? Pushing up financial markets. But in terms of their actual core business, it's not so good. Lending standards have tightened up a lot. Mortgage loan applications are being rejected, you know, by a large degree. People are having tougher time qualifying to get loans, and this is how a bank makes money outside of trading revenue. But one thing that they did going into the pandemic was increase loan loss reserves. Now, what that is that's setting aside money to pay for losses on debt, right? So somebody doesn't pay their mortgage, defaults on their credit card, whatever it is, that's what the money's for. So they set aside this money in the last quarter to offset these loan loss reserves. Well, here we are a quarter later, and the economy is really not all that much better. You still have a eviction moratorium that's going on at the moment. There's a lot of individuals that are not paying their mortgages and have no ability to pay their mortgages. And ultimately, without more stimulus coming in, there's going to be a shortfall of incomes, which are going to lead to rising credit card defaults and, you know, a variety of other non-payment issues, right? But yet, J.P. Morgan collapsed their loan loss reserves by 94% yesterday in their earnings. So basically, they took all their loan loss reserves that they had set aside, they put it back on their books. That's how they beat earnings yesterday. Bank of America, exactly the same thing today. When they announced earnings, basically their revenues were down sharply. Their trading revenue missed estimates, and however, they were able to beat earnings by massively reducing their loan loss reserves. So I just put a whole bunch of cash back on their balance sheet, right? So now their earnings look like they beat. And you know, this is the problem when you invest. You know, we've turned the markets into a casino, right? It's just red lights and green lights, and it's like a slot machine in Vegas, and you buy stuff and you just kind of hope it goes up. You don't even really pay attention to what the fundamentals are, but fundamentals really do matter over time. And, you know, if you're day trading, I had a conversation with a good friend of mine yesterday, and he's a day trader. And he calls me every now and then. He's like, hey, what do you think about this? But he trades for minutes to hours, maybe a day. Right? And in that type of environment, if you're doing that, you don't need to worry about fundamentals. You're simply looking at technicals and price, and that's it. If you're buying something and you said, hey, I want to own this company long-term, fundamentals matter. And they matter a whole lot. But the problem is most individuals don't actually dig down into these companies and say, well, what is this company actually doing, right? Are they actually earning money? Do they actually make money? Is it a good business model, right? Is there a moat that keeps people from entering into their space and taking business away from them? You know, those are the questions you should be asking, but we don't. Because we've now just gotten sucked into the giant Wall Street casino that, hey, I just throw my money on the table and hopefully I'll win. And this has really kind of been the attitude that's kind of pervaded the market now over the last, you know, decade, more so than anything else over the last decade because of the Federal Reserve. As the Fed does QE, we've now taught investors that, hey, if the Fed's in there throwing money into the markets go up, buy stocks, right? And it's all fine, right, as long as it works. And so far, it's worked, right? You can't argue that, right? When the Fed's active, markets go up. You can't argue that fact. There's a very direct correlation between the Fed's balance sheet and the stock market. Nobody's arguing that. Question is, though, is really twofold. One, will it always work? And two, what about the rest of the economy? Right? I had an interview yesterday with a good friend of mine. We've had him on the show for Daniel Lacalle. And we were doing an interview together on BTN. And the conversation was about recessions. Should we allow recessions to happen? The answer is yes, we should. Recessions are actually a good thing. I've actually got an article coming out on this on Friday about this, because recessions are actually a good thing. We've talked about this before, is that, you've got to go through that cleansing cycle. The problem is that, the Fed doing QE and these type of things is that we have elongated the economic upcycle, and then we try to do everything we can to avoid the down cycle. But the consequence of that is continually slower rates of economic growth and economic prosperity. And we continue to widen the wealth gap. Top 10% of the economy owns 88% of the stock market. Everybody else, not so much. But this is the choices that we make, right? And really, unfortunately, I've joked about this before, is that when I die, on my tombstone, it'll say, "Here lies Lance Roberts. He's still waiting on value to come back." But that's the issue that we've gotten into. We're supposed to be investing based on the value of a company and what the future cash flows are going to be. But that died basically about 5 years ago. And about 5 years ago was when the mass market understood the dynamic of the Federal Reserve and what the implications are of quantitative easing and how it fuels asset prices. It doesn't make the economy any stronger, right? We continue to chug along at about 2% growth, not getting any real strong. It's more deflationary in nature than not. Can't really get inflation. Fed's trying to figure out all kinds of ways to jigger inflation to get a higher inflation reading. But and it certainly doesn't help the economic prosperity of the masses. Again, when you take a look at wage growth, I just did a report on this. The Federal Reserve does a study every 3 years. And we just had a report on this last Monday. And what the Fed study just came out that covered from 2016 to 2019. And if you go back, the average median income growth for households in the bottom 90% is the same as it was back in 1998. The average net worth of households in the bottom 90% is actually lower than it was in 2007. The number of households that have retirement accounts is less than it was in 2007. And this is after a decade of economic growth, right? And market growth. 90% of Americans are not better off because of what the Federal Reserve did. And it may seem like, and this is one of the, kind of one of the problems, is that, we look at the stock market and we go, well, the stock market's doing great. Must mean the economy's doing fantastic. And that's not necessarily the case. And what we also don't look at is we don't look at revenue for these companies. We've come up with all kinds of measures now to inflate the valuations of companies, right? So we come up with operating earnings, which are earnings that I wish I would have had. Had I not had anything else go on, like, paying bills or need to have a write-off or I lost money on an investment, whatever. Operating earnings are, if everything had gone perfectly well, this is what my earnings would have been. And that's what they all report now, right? So when you listen to earnings, those are operating earnings, right? You'll see it next to, it'll say Q2 adjusted earnings. These are all the adjustments for making them look better than the real. But if you look at reported earnings, it's a vastly different story. And more importantly, if you take a look at sales growth over the last decade, it's a tremendously different story. Yes, operating earnings are up like 300% since 2009 in total. Revenue is up like 40%. The economy and the market are a reflection of each other. We have distorted the price of the market because of things from the Federal Reserve and speculation in markets and driving asset prices much higher than they should be normally. But again, that's why we are now in this process of continued booms and busts rather than a more normal market environment like we saw previously. Quick break, be right back.
She says we gotta hold on to what we've got. It doesn't make a difference if we make it or not.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live GoToWebinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.